I'm Arsenault, and I lead the team that produces our quarterly newsletter, Market Point. 2021 was a great year for equity investors. Global equities were up 21.8% last year. The ability of economies and companies to adjust and adapt to the pandemic was truly remarkable. Corporate earnings were strong, and equity investors were rewarded. So far, 2022 has been more difficult for stocks, however. In the first quarter, the S&P 500, a proxy for large domestic publicly traded companies, declined 4.6%, while stocks outside the US fell by 5.4%. In our opinion, the invasion of Ukraine by Russia was the most important event this past quarter. Not only did it negatively impact the growth outlook and corporate earnings expectations going forward, but it also boosted inflation expectations. Less growth and more inflation is generally not a good recipe for risk assets like equities. Interestingly, the correction in equity markets did not provide support to the bond market in the first quarter. In fact, as shown on the chart here, bonds were down even more than stocks in the first quarter, with the US Ag Bond Index, a proxy for high-quality US bonds, declining 5.9%, the worst drawdown since 1980. The poor performance of bonds certainly caught many investors by surprise, but reinforced the importance of allocating to the right fixed income strategies in periods of rising interest rates and rising inflation expectations. We have recently trimmed our equity exposure across portfolios to better reflect growing uncertainty around the outlook going forward. But we still continue to slightly favor stocks over bonds. Within equities, our preference remains with value stocks over growth stocks. The rapid downgrade of growth stocks valuations in the past several months reinforced our view that growth stocks will continue to remain under pressure from rising interest rates going forward. Within fixed income, while we have recently reduced credit exposure in portfolios, we still prefer credit over government bonds. We are also maintaining inflation hedges and keeping portfolio duration below benchmark for the time being. As always, our clients' portfolios continue to reflect our best ideas, and we will remain flexible all year to adjust to changing information and market conditions. Thank you for listening, and I certainly hope you enjoy reading our newsletter, Market Point. Please click the link in this email for a more complete review of our thoughts and insights. For additional articles, newsletters, and more, make sure to follow us on Facebook, LinkedIn, and trustpointinc.com. Thank you.